brought to you by IG, taking a look at the US dollar and the chances of a collapse in USD, given so much volatility that's kicked in the forex market over the course of the last couple of weeks. We'll get into those couple of weeks in just a second, but I do want to give some context for US dollar in recent years. And to give that longer context of USD against euro, yen, and pound from a broad perspective, we're taking a look at the UUP ETF, which is showing you here that, you know, in the forex world, it's pretty unprecedented that you see a 5 to 10% move over the course of a year or a couple of years. US dollar using this ETF is up 20% since 2021. Huge move in terms of forex markets. And this is a market that usually, and by usually, I mean going back almost 20 years, has traded between $20 and $26 a share. And they haven't seen, below 27 or 26 for the last couple of years here. Really has moved outside of this range to the upside. The US dollar has. And even though it's come off of its peak of around $30 a share using this ETF, it's held on to a lot of those gains. So this is all to say it's been a good few years in US dollar. Now, I want to have that context and move forward into, okay, so then what would a collapse look like in US dollar? And in terms of this ETF, it would really look like falling back below $27, which has been the low for the last couple of years. And with that context, you can see like, man, the likelihood should be pretty high, right? That's where we spent a lot of time historically. And so it's kind of the idea of like the bigger they are, the harder they fall. If this is a market that has gained 20% in the last 2 years here, then it could probably cough that up in a year or two, theoretically. But we're going to look at some option prices that may say something different. Beforehand, what are we looking at? We're looking at the US dollar against the euro, against the yen, against the pound, against Canadian dollar primarily, and also some Swiss franc and Swedish krona in there as well. And so below $27 would be a little bit of a collapse here. That's not what we've seen in the last couple of years. And now let's take a look at the chances of that type of collapse. And looking at the market for options on UUP for the rest of this year, expiring at the end of the year, that 27 strike put is actually only showing a 9 delta, a theoretical 9% chance of the market closing the year below that level, which would correlate to around 115, being above 115 in terms of euro US dollar, or above around 130 or so in pound versus the dollar, or back down to the 130 handle or so in terms of dollar versus yen. And yeah, the market really not pricing in a significant chance of a US dollar collapse at this stage. And a lot of this has to do with the recent dollar strength that we've seen over the course of the last couple of weeks here, that has been coinciding with US rates moving towards their highs. You see this 10-year back above 4%, nearing its highs since 2007. Some real historical extremes that we're seeing in terms of US rates that you can't help but correlate to the US dollar resurging at the same time. And so I wanted to take a look at the correlation between, not US dollar and these foreign currencies, which obviously would be really starkly negative. If US dollar is moving higher, then obviously the euro versus US dollar is probably moving lower. But looking at US interest rates and their correlation to the euro, pound, and Swiss franc, because that should be a little bit more nuanced, right? There's a world in which US interest rates move higher by a percentage in whatever time period, and European interest rates move higher by 1.5% or 2% in that same time frame, and essentially denoting that higher interest rates could be good for the euro or the pound. Hasn't been the case, because you see the stark negative correlations between U.S. interest rates and the euro and the pound and the Swiss franc, and then to a lesser extent, Aussie, Canada. And I was surprised to see yen the least correlated to U.S. interest rates. And so what does this all mean? Well, if U.S. interest rates climb not only above 4% or get up to 5% or beyond, given historical correlations, you might see that U.S. dollar continue higher and the euro fall lower, the pound fall lower, the Swiss franc depreciate as well, Aussie, Canada, and yen to a lesser extent, given these historical correlations. On the flip side, if 4% holds as the high for U.S. rates once again, and they fall back lower, then you might see a little bit of this U.S. dollar crash potential or collapse potential, which might bring that euro versus the dollar up to 115, or the pound back up to 130 and above. Or we've recently seen the lows in dollar versus Swiss franc, but obviously dollar bouncing back given this recent resurgence. The European currencies really stand to be the biggest profiters necessarily of U.S. interest rates falling, given these historical correlations. Of course, anything can change in the future. These correlations don't have to hold, but U.S. interest rates moving higher historically have been met with depreciating currencies against the U.S. dollar. And now, just a last look at, it's not always the best strategy to trade foreign exchange markets in terms of ETF shares, just given that most stocks and ETFs are margined at anywhere from 50 to 100%, and forex markets are less volatile than stocks. They have usually a lower implied volatility in their options, denoting less volatile price action. And that's why obviously forex markets tend to be higher leverage, because in a given year that the stock market might move anywhere between 10, 20, even 30% on a big year, you're usually looking at half of that or a third of that in currency markets like the euro versus the dollar. And so if you wanted to not necessarily look at one market like euro dollar, but look at that basket that we were looking at, not in ETF terms, but in forex terms, with the leverage and everything else, the margin requirements as low as 2% for markets like Eurodollar, you can create that basket with fractional lot sizes in forex markets to take advantage of that capital efficiency. And the weightings in that US dollar basket right now are around, half euro and 15 to 20% yen, and around 10% pound, around 10% Canadian dollar, and a little bit less than 10% Swiss franc. So can use those fractional lot sizes to create that basket if you want to trade the dollar to the downside on the potential of a collapse, or trade it to the upside that it could resurge back to those highs that we saw last year. It'll be really interesting to see, as that dollar is right between that potential collapse and the potential resurgence to historical highs.